Today's lecture is a very important one, in the sense that we'll cover everything we've covered in our previous 22 or 23 lectures. This includes how to identify trends, how to find end liquidity, how to find incentives, how to identify break-even structures, how to trade in the direction of a trend, how to trade counter trends, how to use the VICO hint I gave you, how to avoid low probability trades, how to take high probability trades, how to define stop losses, how to define take profits. If you watch this lecture, many of your confusions will be cleared up. And in this complete lecture, what we call putting it all together, this collection of complete concepts will greatly enhance your trading. If you're a true SMC trader and want to trade long-term and based solely on SMC, this lecture will prove very useful for you. In this lecture, we'll look at how to use all these concepts. As I wrote here, SMC is the end. It may be the end of smart money concepts, but not of your learning. For your learning, I'll further explain how to align smart money concepts with volume and ICT, which will further increase your profitability. Now, before delving into further study, just as I share some tips and tricks at the beginning of every lecture, I explain some rules. Today, we'll start with a schematic using those rules. Here, I'll give you a brief overview of what we'll cover in this lecture, the purpose of those concepts, and how to utilize them. Suppose we're in a bullish trend. We'll see how to apply all the concepts of smart money concepts to a bullish trend. So, this first valid pullback is our incentive level. And whenever the market moves above this incentive after sweeping, only sweeping below, and closing above, this is our break-off structure. Okay? And since this is an ending note for you all, here I'll also tell you how to plan your entry and how to take it. Remember, when the market breaks out of structure, it only sweeps the candle's wick below the incentive. So, that's just a break-off structure. We don't call such points swing points. What's the difference between a break-off structure and a swing point? Our lectures are available in great detail on this. Please read them. Here too, I'll give you a little indication and a little introduction. Now, when the market breaks out of structure, it creates a new incentive level. Below this inducement, we have a buy zone available. Remember, this buy zone is tradable. Why? Because only the buy zone formed during the break-off structure leg, if it also contains an inducement, is a tradable zone because the market has swept liquidity from its left side here, in the form of an inducement in the form of internal liquidity. Therefore, the break-off structure leg is also tradable. Here, when the market reaches the buy zone after this inducement, we can plan our trade. Here, the market has again taken an inducement and closed higher. Now, since there is a close below and above the inducement, this is both our break-off structure and our swing point. I've written hints on the left side, indicating that the blue point is our higher high, and the green point is our higher low. Because there is a close below and above the inducement, there is a close above. The difference between a break-off structure and a swing point is that a break-off structure alone indicates trend continuation. Whereas where swing points form, the trend continuation and plus signify a critical level. This is the point where, if this higher low is broken, your trend could change, and the liquidity lying below it will remain protected until the market breaks this higher low. Now, the market has broken the structure, generating a new indication, and a buy zone is available below this indication. So, we can trade this as well. However, whenever your market enters a buy zone, you shouldn't take a direct entry. So, how should you enter? You can confirm your entry here by relying on the market structure shift on a lower time frame, which we call MSS, or the swing base change of character, or the sweep base entry module, which we studied in the last lecture, which I will also explain in today's lecture. How do we trade on the same time frame as before, and how do we get confirmation on a lower time frame along with a larger time frame? Now, what exactly is an MSS? You've already studied this in great detail. I've pasted a small image here. Essentially, upon reaching this zone, the market will form an internal low, sweeping away its liquidity. Then, the market will expand, generating a new adjustment, and we can plan our trade from the resulting fair value gap, or buy zone. This is called an MSS. Here, we can buy again based on this MSS because the market has accepted the indication. Now, when the market accepts the indication, closes below or above the close, a break-off structure is created, creating your swing point. After this break-off structure, we find a new adjustment and then plan a new trade. Now, below this adjustment, we have this buy zone. Whenever the market falls below the indicator and the candle body closes below the indicator, if a sell-side fair value gap is generated during that swing, you can plan a counter-trend trade from here. Why? Because if the candle body closes below the indicator on a major time frame, we can find a counter-trend trade. Where? Up to the first buy zone. If there were another buy zone here, that would be our take profit. But if there is only one buy zone, we will sell from here, take profit up to this buy zone, and then trade in the direction of the buy zone here, that would be our take profit. But if there is only one buy zone, we will sell from here, take profit up to this buy zone, and then trade in the direction of the trend again. Now, whenever the market gives you a sell-side trade, we become overconfident and remain in the sell position. You should not sell the market completely until this higher low is broken, meaning there is a change of character here. This trade was a counter trend, the basic rule of which is that the market should close below the major timeframe's incentive, and a fair value gap should also be available in that leg. Now, when the market returns here, we can plan our trade based on the market structure shift. The market has once again broken out of its structure and created swing points. This means that all liquidity is now protected below this low. The market has created a new incentive, and this is our buy zone. Now, what does the market do at this point? It drops and doesn't take up our incentive, which is internal liquidity. What does the market do? It starts ranging. It doesn't take up the incentive and creates internal liquidity there, generating its own new liquidity. Now, this is that position, this is that level, or this is a case study where you can plan a trade without any incentive. How is that when the market doesn't accept the inducement and starts ranging at a specific point, then we wait for a low side liquidity sweep? As I mentioned in the last lecture, if the market decides to go buy, it will take up liquidity on the sell side. After absorbing the liquidity on the sell side, the market will again shift structure, of which this is a complete example. This will be the 12th or 13th lecture in our playlist, so definitely watch it. This is the core of structure mapping, or rather the core of anti-techniques, based on which you can get confirmation of anti-techniques. If a fair value gap is created in the MSS, we can ride our retrend using that fair value gap. But remember one thing, while the market has given you a trade based on liquidity, the breakoff of the structure formed here will not be valid because the market did not accept the inducement. Induction occurs on the left side of any high. If the market makes a pullback on the right, it merely provides liquidity. These are not endorsement levels, and a breakoff structure formed at their base is not valid. A breakoff structure will only occur if the market receives endorsement from the left. Okay? So, this is the section or setup that we can trade without endorsement. You could call it AMD, accumulation, manipulation, distribution, or power of 3. I've summarized some of what you've read so far at the top. This summary explains that, basically, the buy zone formed during a breakoff structure can also be traded. When should a countertrend be traded? When the market creates a fair value gap in the sell-sell leg. Okay, after that, if the market doesn't take endorsement, how should it be traded? The market should create an AMD power of 3, or an internal range, and provide an MSS after sweeping it. And finally, never take a trade without a structure shift. You must wait for a structure shift in every buy zone. You must plan your trade only when the market structure shifts. We practice everything we've learned so far in the live market. We study some examples and look at some case studies to understand how to view the market from A to G and how to take trades. Now, here's a chart of a UD